Anand Tandon, that there seems to be a big change of heart from the investors and also from the promoters, stroke founders, that what are the essentials to survive in auction market. And that I think is getting rewarded in the way how Zomato stock price has gone up post numbers, how Policy Bazaar has gone up off late. But now that markets are convinced that these folks are here to, and they mean business, what is the way forward after the recent run-up?
I think you have to look at first two things. One is which of them is still able to raise money, or at least has enough cash to give them a long enough runway till they reach profitability. And the second is that, if you assume that there is going to be a focus on cash flow and profitability, how much of the top line growth will have to go? Because so far, or at least till they went into IPO, the focus was on trying to gain more and more market share and build up the top line and not worry too much about the cost of client acquisition. So eventually, cost of client acquisition has to be brought down to a level where it begins to make sense and you start making operating profit. So some of the ones that you mentioned right now, for example, Zomato is showing some signs of progressing in that direction. The challenge there I still think is quite high because there is the cost of logistics cannot be brought down beyond a point, and the challenge will remain that there is already some amount of pushback from the restaurants and the food suppliers to the margins that they are having to shell out to these companies. They are doing it because of the fact that it brings them new business, but it is very likely that the hyper local market will, in some form or shape, begin to segregate. If you look at Paytm, for example, obviously there the monetization has started to some extent, because if you look at what the vendors are paying them, etc., they have actually moved into being a payment bank of some size, and therefore, to that extent, the fact that they have the largest number of vendors in their fold will probably give them some revenue traction going forward on a continual basis. Many of the others, to my mind, are still struggling with the kind of growth versus profitability syndrome. So I think you have to essentially look at assuming that a few years out they all become profitable. How much are you paying for them today, and how much do you think that they will go up after that? Because obviously, 40% compounded growth is not something that you can factor in for the longest time. India still remains, for example, for a business like Zomato, to my mind, remains a market which is only in a few cities even now. So things will have to evolve. To my mind, some of them are still fairly expensive. But because of the fact that there is now at least a path to profitability, there is a reason to assume that they will survive and therefore do reasonably well over a period of time. We have already seen major problems with ones like Baiju, and I think that's the lesson you have to learn, that too much of a good thing can also be bad. So just because somebody is putting up valuations every alternate day by a few billion doesn't really mean that the real world agrees with that.
No, a fair balance is what you're suggesting, and fair point there. Just quickly.
Well, if you have to look at the banks, I think especially in the private sector, almost anyone which is of a reasonable quality in terms of technology will do well in terms of taking market share from some of the public sector banks. That's a trend that has been going on for the last 2 decades, will likely continue to go on for the next 1 decade at least. So from that perspective, an RBL or whatever is likely to continue to do reasonably well. The challenge really is that most of the smaller banks especially focus too much on the consumer side, and that means that they are not well enough diversified in terms of the portfolio. So while consumers are doing well at the stage and have been for the last several years, they are missing out on all the incremental gains that are likely to come from the industrial lending, which is where the preference for a larger bank comes from, that you have both a mix of industrial as well as consumer lending, and you are therefore able to manage the cycles in the lending much better. Also, the larger projects can only be funded by the larger balance sheets. So if you are really looking at banks, I would argue that the frontline banks are not very much more costlier than the smaller banks, and the growth right now is not a constraint. All of them are growing reasonably well. In fact, the challenge is being able to raise liabilities. And a better network is always better. So again, it favors a larger bank. So net, I would focus on the private sector banks on the larger side rather than too much on the small banks.
Sure, point taken. Just wanted to address the flashes at the bottom of Anand. What's your take regarding the entire consumer durables basket? Because numbers weren't impressive, at least from the the AC makers of sorts, whether it was a Blue Star or a Voltas. But on the other hand, you have real estate demand which continues to perk up. Would you rather play through the other names, the cables and wires, the other building material names, the likes of Polycab, Havells, etc.?
Well, if you are looking to play the housing thing, I think your best way of playing it is through the financial markets. Housing finance and the banks themselves are actually a good way to play it. The real estate remains quite difficult to handle because obviously, it depends on where you're going to be positioned. So each of those, the real estate companies have their own quirks. And the consumer durable space again is a derived demand. So while it is something that has shown fairly strong growth, none of them are particularly cheap to my view. So if you are, the simplest way of doing it, as I said, is through the financial market.